Assalamualaikum and welcome to our video. In this video, I would like to discuss about the comparative analysis of 7-Eleven company. So this is our group member, consists of 4 people. 7-Eleven company was founded by J.C. Thompson in 1927 as the Saltland Ice Company in Dallas, Texas. In 1946, they changed the name of their grocery store to 7-Eleven. The vision of 7-Eleven is to be the best retailer of convenience, and the mission is to consistently serve the changing needs of customers for their convenience. 7-Eleven Malaysia Holding Berhad, however, was established on 4 June 1984 as a fully owned subsidiary to manage the operation of 7-Eleven convenience store in Malaysia. It is one of Malaysia's biggest 24-hour convenience store and serves more than 900 customers daily with the maximum number of stores of 2,250 national stores. The company owns and operates a convenience store chain which sells a variety of grocery and food products, including Slurpee, hot meat and drink. Moreover, they also manage the distribution of mobile phone reload, touch and go, and bill payment services. So, based on the assignment for subject financial statement analysis, we have made comparative analysis of 7-Eleven company based on the year 2019 and 2020.
I'm going to present about year-to-year changes. For the financial year of 2019, the total asset is decreasing for 62,250 ringgit from the previous year, which is 2018, with the negative 196.98% of changes. The total equities for the same year is also decreasing for 87,992 ringgit, with the negative 115.26% of changes, while the total liability is increasing for 40,285 ringgit with the negative 46.39% of changes. The total of liabilities and equities is increasing for 47,707 ringgit with a negative 191.95% of changes. The changes of net profit for the same year is decreasing for 50,011 with the negative 115.03% of changes. For the financial year of 2020, the total asset is increasing for 397,324 ringgit from the previous year, which is 2019, with the 940,163.95% of changes. The total equity for the same year increasing for 56,309 ringgit with the 963.88% of changes, while the total liabilities is increasing for 39,496 ringgit with the 89.32% of changes. The total liability and equity is increasing for 95,805 with the 1,053.2% of changes. The changes in the net profit for the same year is increasing for 49,343 ringgit with the negative 948.03% of changes. For index number, from the financial year 2018 to 2019, the balance is decreasing to 95.75, but it's increasing to 122.85 for the year of 2020. Meanwhile, the net profit from the year 2018 to 2019 is decreasing to 9.22%, but increasing to 97.90% for the year of 2020. For the common size analysis, sundry receivable, debt recoverable, and cash and bank balance are increasing from 2018 to 2019, but only sundry receivable and cash and bank balance are increasing from 2019 to 2020, with debt recoverable remain the same. Investment in subsidiary company is increasing from 2018 to 2019 but decreased from 2019 to 2020. Other payables is decreasing from 2018 to 2019 but increased from 2019 to 2020. In 2018 and 2019 there is no borrowings, but in 2020 current liabilities borrowing is 2.09% and non-current liabilities borrowing is 17.79%. Share capital is increasing from 2018 to 2019 but decreased in 2020. Treasury share and return profit are decreasing from 2018 to 2019, but in 2020 only return profit is increasing while treasury share is decreasing. There is no cost of sales from 2018 to 2020, which made the gross profit is 100% for 3 years. The profit from operations, profit before tax and profit after tax are decreasing from 2018 to 2019 and increase again from 2019 to 2020.
Based on the table that I have shown, the current ratio from 2018 to 2019 decreased and in 2020 increased. In 2018, 2019 and 2020, the current ratio is 0.75, 0.03 and 0.90 respectively. So we can conclude that in 2018 to 2020, 7-Eleven is not able to pay current liabilities with its current asset because in this year, it is highly risked. Since the 7E ratio is so low, it is unlikely that the firm will get approved for their loan. Next, the table given is net working capital. It shows that that net working capital from 2018 to 2020 will be negative. Net working capital in 2018, 2019 and 2020 is 21,391, negative 43,357 and negative 43,678 respectively. It means the firm has less current assets than current liabilities. The firm is able to meet short-term obligations and lowers opportunity costs. So in that case, the ideal position is to have more current assets than current liabilities and thus have a positive net working capital balance. Based on the table, the company of 7-Eleven shows that in 2018 to 2020, the net profit margin of which is 91.03%, 51.03% and 67.62% respectively. It means the ratio is lower from 2018 to 2020 and the firm is not efficient at converting sales into actual profit. In 2018, the firm has 91% of net income for every 1 ringgit of sale in 2019 and 2020. A higher profit margin means the firm has more cash to pay for indirect and other costs such as interest and expenses. In 2019, net profit margin is lower than other years, which is 51.03%. It means the firm managed its expenses not very well relative to its net sale in 2019. For return on equity, the result shows that the ratio decreased from 2018 to 2019 and increased back in 2020, which is 4.03%, 0.38% and 4.01% respectively. In 3 years, 2018 is a higher ratio and it shows the firm has 40 cents to return on equity for every 1 ringgit of their investment. The firm also can generate a high return on equity is considered to be a good investment, which drive up its shares price in 2018. In 2019, the ROE is lower than 2018, which is 0.38% only. It means the firm of management is making poor decisions on reinvesting capital in unproductive assets.
7-Eleven Malaysia has a debt ratio of 3.19% and 24.56% for the year of 2019 and 2020 respectively. When a company risk level is high and its debt ratio is high, it's clear that the company has taken a lot of risks. 7-Eleven Malaysia has a high debt ratio of 24.56% in 2020, indicating that the debt rather than equity is used to fund the majority of its assets. The debt to equity ratio, on the other hand, provides information about the company debt usage. In 2019 and 2020, 7-Eleven Malaysia got 0.0330 times and 0.3255 times debt. financing from its debtor respectively for every RM1 Malaysia equity
As
financing.
a result, the analysis of 7-Eleven has account receivable turnover ratio of 0.33 times and 0.42 times for the year 2019 and 2020 respectively. It shows that the increased ratio from 2019 to 2020. As we can see, in 2020, it shows the higher account receivable turnover ratio is 0.42 compared to 2019, which is 0.33. So, it shows that the 7-Eleven is efficient in using account receivable to generate sales because higher ratio is the better. It indicates that the 7-Eleven company has better turnover in 2020. Next, the analysis for total asset turnover ratio of 7-Eleven is 7.16 times in 2019 and 0.04 times in 2020. It shows an increase from 2019 to 2020. As we can see, in 2019 is showing that the total asset turnover is the higher ratio of 7.16 times compared to 2020, which is 0.04. So, it shows that the 7-Eleven for 2020 is not effectiveness in using total asset to generate sales. So, we can conclude that the 7-Eleven company has a better turnover in 2019, which is 7.16 times. This is because higher ratio is favorable and also show the amount of sales generated from investment in asset.
There are a few of trends that found. Firstly, the most convenient store. 7-Eleven Malaysia Holding Berhad has been dominant icon and left its mark on the retail landscape for more than 30 years. They have 2,250 outlets across Malaysia and serve nearly 1 million customers every day. Secondly, 7-Eleven is Malaysia's most famous convenience store branch. Despite the presence of competitors such as Family Mart and 99 Speed Mart, 7-Eleven is the most popular. It also the region's latest stand-alone convenience worldwide and a wholly owned subsidiary of 7-Eleven Malaysia Holding Berhad. Thirdly, consumer can purchase gift card, PayB and top up mobile prepaid. Customers will be able to pay their Maxis, Celcom, U-Mobile, TM and Astro bill without having to wait long in several Malaysian shops. Last but not least, Community Care Program. 7-Eleven also participate in a Corporate Social Responsibility (CSR) program in which it works with some of Asian non-governmental organizations to promote any community without any discrimination and to ensure that everyone benefits. Even if the community program is a non-profit. Now, let's move on to the weakness. For the first weakness is high cost of staff. This is due to the store operate 24 hours and 2,250 outlets across Malaysia. So that we can conclude that more stores are being opened, more salaries are being paid. Secondly, high overhead costs. Overhead or indirect costs are expenses that are not directly related to the production of a good or service. This is due to the fact that 7-Eleven Malaysia sponsored commodity development or distribution activity, which had an effect on income statement earning. Thirdly, high pricing of product. The introduction of taxes such as GST or the most common SST has resulted in a significant increase in retail price, which had a significant impact on the sector. With the implementation of the Goods and Service Tax, GST and the subsequent effect of the GST as well as other global and domestic events that have impacted the price of the goods and services. Lastly, limited brand offering. They only offer a limited number of brands which fail to meet some customer demand. For example, dairy milk brands such as Dash Lady, Good Day and Farm Fresh are only available at certain 7-Eleven Malaysia outlets, limiting customer option to obtain them because such brands are only available at certain outlets. For end this presentation, I would like to suggest a few of suggestions to 7-Eleven Malaysia. First, do more promotion or campaign half price. 7-Eleven should run a promotion such as a half price campaign in which the price of the product is reduced to entice customers to return. Secondly, make a planner financial cost. All types of organization or business will suffer losses as a result of excessive liability or debt incurred. A financial cost planner present in an organization will, to some extent, ensure the company's future. They can also plan acquisition strategy. Furthermore, 7-Eleven Malaysia can handle any financial issue that may arise. Thirdly, identify the close competitor. 7-Eleven must be aware of its competitor in order to deal with them effectively. One of the first steps 7-Eleven must take is to identify who and where our competitors are located. Lastly, modified food or product packaging method. In order to make their packaging more appealing, all parties must keep it up to date. The product of 7-Eleven packaging must be replaced on a regular basis. 7-Eleven can also add product brand that its competitor frequently provided. For example, like the ready-to-eat food that available at FamilyMart. So, we can conclude here. In Malaysia, 7-Eleven proudly claims to be one of the top convenience store brands in the market, having been a business for more than 30 years. More importantly, 7-Eleven Malaysia successfully achieved strong brand recognition, which was followed by the significant public presence. When it comes to purchasing convenient products and services, Malaysian customers will actively seek out a 7-Eleven store due to the wide range of products and technical services offered. Furthermore, because 7-Eleven has established a number of stores in Malaysia, with a total of 2,250 stores nationwide, it is undeniable that this company is the most accessible and convenient store that a customer could ever have. That's all from me. Thank you.